My dear students, welcome back to our channel. In this video, I will be explaining the MBA 4th semester subject International Finance as prescribed by Osmania University and other universities of Telangana. We will go through the important questions and answers one by one. Let's begin with a quick revision. Quick tip to prepare smartly. Theory focus, understand TP, tax types, tax planning, and international tax rules. Examples, always add examples like Apple, Google, Infosys, or McDonald's using tax planning. Numericals, if any basic TP calculation or tax credit application. Unit 5 first important short question is: what are reinvoicing centers? Reinvoicing centers are offices set up by multinational companies in low-tax countries to handle international trade invoices. Their main purpose is to reduce tax and manage currency risk. Instead of selling goods directly to a foreign customer, a company first sends the invoice to its reinvoicing center, which then sells to the final buyer. This process is mostly paperwork, not physical movement of goods. Example: Tata Steel, India, sells steel to a US buyer. But instead of billing the US company directly, Tata first invoices its reinvoicing center in Singapore, where tax is low. The Singapore center then invoices the US buyer. So, profit gets recorded in Singapore, not India, helping reduce total taxes. Why use it? To shift profits to low-tax nations. To control currency risk. To centralize invoicing. Memory tip: reroute your invoice, reduce your tax voice. It's a smart tax planning method used in international finance. Next important short question is: 2. What is double taxation avoidance? Double taxation happens when a person or company is taxed twice on the same income, once in the home country and once in the foreign country. To solve this problem, countries sign double taxation avoidance agreements, DTA. These agreements ensure that income is taxed only once, or that tax credit is given in one country for tax paid in the other. Example: an Indian software engineer works in the USA and pays tax there. If India also tries to tax that same income, he would be paying tax twice. But because India and the USA have a DTA, he can avoid double tax either by paying tax in only one country or by getting credit in India for tax paid in the USA. Why is it important? Encourages foreign income and investment. Protects individuals and companies from unfair tax burden. Memory tip: earn once, tax once, not twice. It's a win-win for global taxpayers. Next important short question is: 3. What is Tobin Tax? Tobin Tax is a small tax proposed on foreign currency transactions. It was suggested by economist James Tobin to control short-term currency trading that can harm a country's economy. When traders quickly buy and sell currencies to make profit, called speculation, it can cause big ups and downs in exchange rates. Tobin said that if we put a small tax, like 0.1%, on every currency trade, it will slow down unnecessary trading and bring stability to global markets. Example: if a trader buys $1 million worth of rupees and sells it within minutes to make a tiny profit, Tobin tax will reduce that profit or even cause a loss. So, only serious, long-term trades will happen. Why is Tobin tax important? Controls speculation. Reduces currency market volatility. Generates revenue for poor countries. Memory tip: tiny Tobin tax is equal to stop fast cash attacks. It's like a speed breaker for risky currency trading. Next important short question is 4. What are tax havens? Tax havens are countries or places where tax rates are very low or zero, and financial laws are relaxed and secretive. People and companies use tax havens to avoid paying high taxes in their own country, legally or sometimes illegally. Example: a big company like Apple or Infosys may set up a branch in a tax haven like the Cayman Islands or Bermuda. They show profits there, on paper, even if the business is done elsewhere. Since those countries charge very low or no tax, the company saves a lot of money. Why do people use tax havens? To pay less tax. To hide money or income. To enjoy privacy in financial transactions. Memory tip: hide your gold in a tax-free fold. But remember, while tax planning is legal, tax evasion using havens can be illegal and lead to punishment. Many countries are now taking steps to stop such practices. Next important short question is 5. What is a controlled foreign corporation, CFC? A controlled foreign corporation, CFC, is a company that is registered in a foreign country but is controlled by residents of another country. Usually, this is done to take advantage of lower taxes in that foreign country. Governments use CFC rules to stop people or companies from shifting profits to low-tax countries just to avoid tax in their home country. Example: an Indian company creates a company in Dubai, where corporate tax is low. Even if the real control and profits stay in India, the company claims income is earned in Dubai to pay less tax. But Indian CFC rules can bring back that income and tax it in India. Why CFC rules are important? To prevent tax evasion. To ensure fair taxation. To stop profit shifting. Memory tip: control abroad. Tax at home. CFC rules make sure income earned abroad doesn't escape tax unfairly. Next unit 5. Long questions. First important long question is 1. Explain the various types methods of taxes in the international environment. In international finance, companies and individuals often earn money across countries. So, understanding the types of taxes in the international environment is very important. These taxes are applied by governments to collect revenue and regulate trade. 1. Income tax. Charged on the income earned by individuals or businesses. Example: if an Indian company earns profit in the USA, the US government charges income tax on that profit. 2. Withholding tax. Tax deducted at source on income like interest, dividends, or royalties paid to a foreign person or company. Example: if Infosys pays dividends to a US shareholder, India may deduct withholding tax before payment. 3. Value added tax, VAT, GST. A tax on the value added at each stage of production or sale. Many countries apply VAT or GST. Example: when a product is sold in Europe, VAT is included in the price. 4. Tobin Tax. A small tax on foreign currency transactions to reduce speculative trading and stabilize currency markets. Example: if a trader quickly buys and sells euros for profit, Tobin tax will apply. 5. Capital gains tax. Tax on the profit made from selling assets like shares, property, etc. This applies if the asset is in a foreign country. Example: selling Google shares by an Indian investor may attract US capital gains tax. 6. Customs duties. Taxes on goods imported or exported across countries. Example: if India imports phones from China, customs duty is added to the cost. Why these taxes matter? Help governments earn revenue. Prevent tax evasion. Promote fair global trade. Easy memory tip. Income in, profit out, goods cross, tax comes all about. These taxes play a key role in international business and influence investment, pricing, and profit decisions. Next important long question is to discuss the international taxation methods. When individuals or companies earn money in foreign countries, it can be taxed by both the home and foreign countries. To avoid this, there are international taxation methods used to ensure that income is taxed fairly and only once. 1. Worldwide approach, global method. In this method, a country taxes all income of its residents, whether earned inside or outside the country. Example: if an Indian company earns profit in the USA, and India follows a worldwide approach, then India will also tax that foreign income, along with the US tax. Benefit: encourages transparency. Problem: risk of double taxation. 2. Territorial approach. Here, countries tax income that is earned within their borders only. Income earned outside the country is not taxed. Example: if Singapore follows a territorial system, and a Singapore company earns money in Germany, Singapore does not tax that income. Benefit: no double taxation. Problem: can encourage profit shifting to low-tax countries. 3. Double taxation avoidance agreements, DTA. These are agreements between countries to prevent taxing the same income twice. They provide two methods. A. Exemption method. Foreign income is completely exempt from tax in the home country. Example: if income is taxed in the UK, India doesn't tax it again. B. Tax credit method. Home country gives credit for the tax paid abroad. Example: if you paid 10,000 rupee tax in the US, India will reduce that from your Indian tax bill. Conclusion: international taxation methods help to avoid double taxation, encourage global investment, ensure fair tax collection. Memory tip: worldwide is equal to tax everything. Territorial is equal to tax locally. DTA is equal to share tax fairly. Understanding these methods helps companies and individuals plan taxes smartly when earning across borders. Next important long question is 3. Explain the concept and methods of transfer pricing. What is transfer pricing? Transfer pricing refers to the price charged when one part of a multinational company sells goods or services to another part of the same company in a different country. Since it's the same company, but in different countries, the company can set its own price, which can sometimes be used to reduce taxes. Example: Tata Group has a company in India and another in Singapore. The Indian unit makes car engines and sells them to the Singapore unit. If the Indian unit charges a very low price, profits will be shown in Singapore, which may have lower tax, and not in India. This is where transfer pricing rules are needed to stop tax avoidance. Why is transfer pricing important? To prevent shifting profits to low-tax countries. To ensure fair tax collection. To promote transparency in global trade. Methods of transfer pricing. As per OECD and Indian rules. 1. Comparable uncontrolled price, CUP method. Compare the price of the same product service between independent parties. Example: if an engine is sold to an outsider at 1 lakh rupees, it should also be sold internally at the same rate. 2. Resale price method. Used when the product is bought from a related party and resold to a customer. Formula: sale price, normal margin is equal to transfer price. Example: if a product is sold to a customer at 100 rupees with a 20% profit, the transfer price is equal to 80 rupees. 3. Cost plus method. Add a reasonable profit margin to the cost of producing the product. Example: cost is equal to 70 rupees, profit is equal to 30%, so transfer price is equal to 91 rupees. 4. Profit split method. Used when two units work together on a project. Profits are split based on contribution. 5. Transactional net margin method, TNMM. Compares net profit margin from similar transactions between unrelated firms. Memory tip. Transfer pricing is equal to fair pricing within the family. It keeps the tax game clean across countries and avoids misuse of internal pricing. Next important long question is: 4. Explain the organization structure for reducing tax liabilities. Multinational companies, MNCs, earn profits in many countries. But tax rates differ from one country to another. So, they plan their organization structure smartly to reduce total tax liability without breaking laws. This is called tax-efficient structuring. 1. Branch versus subsidiary structure. A branch is part of the parent company and is taxed as one unit. A subsidiary is a separate legal entity, so companies can plan its location in a low-tax country. Example: an Indian MNC may open a subsidiary in Singapore, low tax, instead of a branch in the UK, high tax. 2. Use of tax havens. Companies open holding companies or affiliates in countries with very low or zero tax havens. Example: Google sets up a subsidiary in the Cayman Islands to hold intellectual property and earn royalty income with little tax. 3. Controlled foreign corporations, CFCs. MNCs control foreign companies in low-tax countries and shift profits there. Governments now apply CFC rules to bring back such profits and tax them. 4. Payments to foreign affiliates. Companies make interest, royalty, or management fee payments to foreign affiliates. These payments are tax-deductible in the home country. Example: an Indian unit pays royalties to a UK affiliate, reducing its Indian profit and tax. 5. Reinvoicing centers and transfer pricing. Companies use reinvoicing centers and smart transfer pricing to move profits to low-tax locations. Example: Infosys sells software to the USA via its Singapore office, shifting profit to Singapore, lower tax. 6. Netting and centralized treasury. Companies use netting to reduce the number of cross-border payments. It lowers transaction costs and tax on each payment. Final tip. By designing the right structure, MNCs reduce tax and increase net profit legally. Memory tip. Place your base in a tax-saving space. It's all about where and how the business is set up globally. Next important long question is: 5. Explain the various transfer pricing methods. What is transfer pricing? Transfer pricing means the price charged when one unit of a multinational company sells goods or services to another unit in a different country, but within the same company. Governments want these prices to be fair so that companies don't avoid taxes by shifting profits to low-tax countries. To ensure fairness, several transfer pricing methods are allowed globally, OECD and Indian tax rules. 1. Comparable uncontrolled price, CUP method. Compare the price charged between two independent companies for similar goods or services. Example: if Infosys charges 1 lakh rupee to an outside client for software, it should also charge the same to its US branch. Tip: compare with outsiders. 2. Resale price method. Used when goods are bought from a related party and then resold to customers. Formula: resale price, normal profit margin is equal to transfer price. Example: if the product sells for 120 rupees and usual profit is 20 rupees, the transfer price is equal to 100 rupees. Tip: sell subtract profit find cost. 3. Cost plus method. Start with the cost of making a product, then add a standard profit margin. Example: if the cost is 80 rupees and profit margin is 25%, transfer price is equal to 100 rupees. Tip: cost plus profit is equal to price. 4. Profit split method. Used when two related parties jointly develop or produce something. The total profit is split based on each party's contribution. Example: two R&D units from India and Germany co-develop software, and profits are split fairly. Tip: work together, split together. 5. Transactional net margin method (TNMM). Compare the net profit margin of a company with other similar companies in the industry. Example: if similar IT companies earn 15% profit, the company's price should also give a 15% margin. Tip: compare profit percentages. Final summary. Transfer pricing methods help ensure fair pricing between related companies. This avoids tax evasion and keeps transactions transparent. Memory hook. Cup checks prices, resale reverses, cost adds up, split shares, TNMM compares.